Live on Sky News Business, this is Trading Day.
Well, welcome to Trading Day Live at lunch. I'm Leanne Jones. Let's check in on what we're watching in the session. The local market is in negative territory there. We're off about 0.5% or so. This among falls in the banks and technology stocks. Now, speaking of one of the bottom movers, we have Domino's Pizza, which is at a 7-week low at the moment, down over or close to 4% there. This follows a downgrade by Morgans to a hold. Now, shares in Sydney Airport are actually pushing higher. They're up about 2% right now. This is amid talk that China is eyeing Sydney's new airport. It's Badgerys Creek as part of its One Belt, One Road infrastructure plan. So a couple of stocks on the radar there today. Let's bring in my guest hosts who join me in the studio this afternoon. Tony Davison from Henderson Maxwell and David Manchie from Belvedere Share Managers. 3 hours into the session, we are still seeing this selling, pretty heavy selling across the banks and miners again. That's sort of the theme really that we've been talking about lately, haven't we, David? What's your view of today's session?
Buyers have gone to lunch. Sellers keep going. It's just more sellers than buyers.
Yeah.
I mean, it's as simple as that. We haven't got any news, and there hasn't been any compelling reason to buy and step into the market with the US close tonight. So we just, as a consequence, we're seeing a bit of weakness follow through. But it's nothing too dramatic, really.
Yep. Okay, yeah, and that's it. It's going to be pretty quiet. We were probably expecting that with the Memorial Day holiday. Probably light volumes going through as well, Tony.
Yeah, there is. The two spots that show just a few signs of life at the moment are REITs and essentially infrastructure, which of course are the bond proxies. Now, bond yields haven't really been a big story in the past couple of weeks. We've focused on other sectors, but it might come back to life in the next few weeks. Bear in mind, we've got a US Fed decision coming up in June. The extent to which it continues to be a relatively dovish set of hikes will probably set the direction for bond yields, vis-a-vis also set a bit of a direction for these stocks. Now, real estate stocks and REITs in particular are certainly not cheap on an historic basis unless you presume that interest rates are going to stay low for a long time. One of the key thinking out there at the moment is that the United States economy is showing some signs of, I suppose, variable economic releases at the moment. And as that variability comes in, bond prices also sort of weakening and in process sort of raising, again, the value of these bond proxies. The key thing is how many more rate hikes will there be in the States if there's not too many more baked into the system, because the condition is deteriorating in the United States, which isn't presently the case. But again, if there aren't too many more hikes baked into it, then REITs and infrastructure stocks may well, again, have a bit of another run, which they haven't had now for a little while.
All right, let's get across more of these moves, actually. And just to note, actually, we are taking your calls. 1300 30 34 35 is the number, and taking your emails as well, yourmoney@skynews.com.au. We'll bring in Joe Mager into the conversation, though. He's from Lake House Capital, live in our Sydney CBD studio. Joe, good to see you there. Now, we're just talking about some of the bright spots, as Tony was pointing out, the REITs and the infrastructure there, those bond proxies. Is that the place to be at the moment, do you think? What's your view on where we should be looking for opportunity?
I tend to think real estate and property at large is rather expensive, and ironically I was looking at the latest rich list ratings that came out, and 5 of the 10 richest people in Australia are wealthiest. That's classier. Their wealth came from property. What's interesting about that is if you look over at New Zealand, it's 1 of 10, and the US it's 0 of 10, and I don't think that Australia is meaningfully different economically. I know there are differences between these countries, but I think that's a pretty stunning difference to have 5 out of 10 coming from one space. And I think when you combine that with affordability issues and just broadly, to his previous point about REITs being expensive, I think property is pretty expensive. And as an asset class, I'd be avoiding it both privately, but also in public markets. So
wouldn't be looking at, sort of investing in those sort of stocks, those REITs at all?
Well, no is the short version.
Yeah.
The longer one is that depending on your time frame, they might fit in well in terms of diversification for your average investor. And of course, if you're buying a home and you plan to live there for a long time, I expect the average person who does that is going to end up doing very well. It's just that property at large, by any measure I can find, is expensive. And I think you can just find little anecdotes like the rich listers who all happen to be in the same place. That's a bit of a contrarian indicator.
So if that's not the place you're looking at, where else? I mean, we talk about these high valuations at the moment, low volatility. Where do we actually look for those opportunities? What are you telling your clients?
Well, we're further out on the risk curve than the average person that's focused on REITs. So I'll just kind of put that out there first and foremost. But we're typically looking at technology companies, and we focus on smalls. And what's interesting is within our benchmark, the Small Words Index, only about 6% of the value is technology companies, but I think that's actually where a lot of the really exciting innovation and value creation is happening within the Australian market. And more broadly, Warren Buffett mentioned at the latest meeting, and he mentioned this several years ago, and it certainly struck a chord with me, which was that if he was looking for a place where he was going to develop skills today as a long-term investor, if he could go back in time, he'd be focused on technology. So that certainly spoke to me, and that's where we tend to put a lot of our focus today, particularly among smaller companies.
Yeah.
Joe, excuse me, Tony Davison from Henderson Maxwell. We were talking, I think, a few weeks ago about WiseTech and how we both thought it was a reasonable stock, and it's continuing to go upwards. And I guess a question for you is, do you think it's fully cooked around these sorts of prices? I mean, it's been a pretty stunning run in the past few weeks.
It has been a pretty great run, which has been enjoyable. I liked it at a lower price, but we haven't sold a share, and this is a business that has some of the best economics of any company that I know of within Australia or otherwise. It's tremendously sticky. Essentially, their product is a software package that amounts to the circulatory system for their customers, so it's incredibly hard to strip out. I think that Richard White is very sharp, has a lot of skin in the game, so it's one that, even though it's not as cheap as it was, we're happy to let this one run.
I'm glad Tony brought that up, actually, because I was going to, you mentioned technology stocks obviously done so well with the NASDAQ in the US at these record highs, but it's often difficult for Australian investors to get that exposure here, isn't it?
It can be, and I think that it is difficult for Australian investors to get as much of that exposure as they'd like. I mean, the reality is that if you look at something like, what's the Google of Australia? It's Google. So I think that can be challenging, but I still think that there are a lot of interesting growth stories here. And I think if you look at something like Atlassian, two guys pretty high up on the rich list themselves who developed a great product here and took that global. So I think they're out there. You just have to look, and the reality is most of them are not going to be consumer-facing. So a common theme of the technology investments we make is a lot of them are enterprise software. It's B2B software, essentially. It's not a Google, it's not an Amazon, which I own both of those, by the way, but they're not consumer-facing. And there's plenty of that here in Australia. It's just not as obvious to the average person watching because they're not buying software from one company to another.
Joe, a stock you mentioned there that gets pretty animated responses depending on their view is Amazon and its potential impact on retailers in Australia. Now, obviously, you're long on the stock, but do you think it's likely to have a really big impact on Main Street retail in Australia, or do you think perhaps, the expectations that have been baked into the market recently and our retailers are a bit overdone?
It's funny because I am super bullish on Amazon. It's my biggest personal position and has been for some time. But interestingly, I tend to agree that a lot of investors are probably overthinking the local impact. I think there's already been a lot of disruption here in terms of a shift to online retail. I think Amazon's presence and the threat of it is going to speed things up. And in particular, I think it's really going to drive pricing, but also speed to customer. And I think that retailers that are able to move quickly and act on that are going to be in a much better position. I think it's really important to remember that Amazon is winning something like 50% of incremental share of e-commerce in the States. But the reality is here, you've got players that have been around for a long, long time and have been investing in their own infrastructure. So I don't think it's realistic that Amazon is going to run away with Australia in the same way that it did the U.S. So, and coming from someone who's very bullish on the company.
And just on that then, Kogan, which is, I guess, the best proxy I can think of. I'm sure there's others out there, just in terms of that relatively pure play e-commerce to retail and so forth. Is that potentially going to come under significant stress with Amazon in Australia, do you think?
It could. They'd probably be one of the names I'd be more concerned about. The company tends to take the view. A lot of companies I find that have a big competitor coming in that's changing the rules of engagement tend to say things like, oh, well, we welcome them as a competitor because they're bringing more interest to the space. It's funny how I always hear that from people that are going to lose market share to someone bigger. I think it's a well-run business. Kogan, I think they do a nice job of pleasing customers, but I think Amazon's first-party selling model and their relentless focus on innovation, speed to customer, low price, selection, satisfaction, it's incredibly difficult to compete with, and I think they're really going to struggle to hang with them over, say, 10 to 15 years. And it's not to say that Kogan can't. I think a common misperception with competing with Amazon is that it's all or nothing, that they're going to run away with the market. It's a big market. It's growing. eBay is still a huge player in the States and elsewhere and has been growing despite Amazon growing much faster. So there's still a growing pie.
I don't disagree with everything you're saying, but it's just there's very different business models, I should say. But Freelancer, I just put my toe in the water recently, and it's just been hammered last year, and now starting to bounce a bit. Just interested in your comments on that, and also iSelect.
I don't really have a strong view on iSelect. We don't have a position in Freelancer, but it's one that I've spent a good bit of time looking at. I think essentially, when you look at margins, they're in the high 80s. Structurally, this business could print cash. There was a big wave of acquisitions and consolidation in the space, not just with them, but their primary U.S. competitor that's now known as Upwork.
Yep.
Upwork raised prices pretty aggressively last year, I believe.
Yep.
And so I feel like there's headroom for Freelancer to either raise prices themselves or just to win share from being the more affordably priced product. I think they're differentiated in the market from Upwork, and it's another, I suppose, B2B offering there that I think is pretty attractive, and I love Matt Berry's ownership stake. I mean, he's got pretty serious skin in the game, and you'd think that's pretty well aligned with long-term investors.
Sure.
Just while we are talking the retailers, just wanted to get your both of your opinions. I mean, obviously the the bricks and mortar stores are suffering. Topshop just recently, and Myers troubles. What is your view on the broader sector, and are there any retailers that you like at all, David?
I think it's amazing. I think for people my age, I suppose, we've always put retail in a really hard basket because it's always been about picking the trends. And even if you're a good retailer and you get next year's trends wrong, regardless of whether you're selling furniture or you're selling clothing, you can go from rooster one day to feather dust to the next. Having said that, then the more broader sort of offerings are not so much subject to that, but they're the more specialised ones. But I think that whether it's the Amazon thing, I don't think it's so much the Amazon thing. I think we've just had an absolute retail recession in buyers, and I think that's hurt the retailers more than anything else across the board. Whether it's interesting now, looking at the prices now of some of the share prices, things like Myer and whatever else, it's almost a binary sort of scenario, because you could actually say I think it's trading on 3 times cash flow. I was just looking at some of the updates from the big brokers this morning, investment houses this morning. 3 times. So you could actually put a case to say that, well, this could easily get taken over for over $1.50, which is sort of double the money. You could also put just as justifiable case to say it's going to be broke in 2 years, not because it's so much gear, but because of all the changes that's happening in the sector. And it's bricks and mortar, and it's locked into the leases, etc. So it's not for the faint-hearted, but I'm actually starting to think that there's actually getting some value in some of these things.
Yeah, okay. And you? Pockets of opportunity, Tony?
And I'll try and keep a lid on it, because I think that there's too much emphasis on Amazon and its potential entry into Australia baked into share prices at the moment. I think in retail there's 2 stories. There's a weak retail environment, as David's talking about, and then there's the fear of the unknown, which is Amazon. And very, very simply, Amazon is going to have a big impact on certain retailers once we know where it's going to be targeted, but it's still going to be a couple of years away, right? So I look at JB Hi-Fi, and I think that is actually an opportunity. It's not for the faint-hearted. You'd need a cast-iron stomach. But you have a look at the Best Buy numbers that came out Thursday night US time, Friday morning our time. That company basically had a share price spike of about 20% on the session, on the back of vastly improved e-commerce numbers, but also very good foot traffic. And the relevance of Best Buy in Australia is that JB Hi-Fi too, is somewhat of an extent, plays in the same sort of place, and it sort of represents itself in a very, very similar way. And I look at that and I say, well, there's a retailer that has struggled in the most competitive retail environment in the world, where e-commerce is predominant as a way of buying electronics and so forth, and yet they've managed to price match and do traditional things that retailers do and get a result, from that. So I think that a lot of what's baked into share prices in retail at the moment is overdone to the downside. Yes, there'll be losers. I think to David's point, someone like Myer is kind of priced for failure at the moment. That's, I think, a broad-scale expectation. But have a look at Harvey Norman, have a look at JB Hi-Fi, different business models, and arguably can compete their way out of a situation. But bear in mind too, we still don't know what Amazon is going to do.
Yeah, that's right.
So much of this is all about, well, they could do this and they could do that. Do we really know? I think it's a little bit early to kind of, call it for a lot of these businesses.
Yeah. Okay, fantastic. We might have to wrap things up there, actually. Joe, we'll let you go. Do appreciate you joining us. Thank you, and we'll look forward to talking to you soon. Joe Mager there. Do stay with us. We'll be answering your questions when we return. Give us a ring. 1300 30 34 35 is the number. Stick around.
Bedtime.
Good night, Doris.
The big banks want to get their hands on your super. And they're putting pressure on our federal politicians to let them in. Banks aren't super. Authorised by D. Whiteley for Industry Super Australia, Melbourne.
130 years ago, 7 men gathered in Broken Hill and dared to think big. The company they created was BHP, the big Australian. Imagine what we could all achieve if we continue to think big.
Filled with indulgence, Lindt Creation Blocks, divine hazelnut, or new salted caramel sundae. Which will you surrender to? Creation from Lindt.
I miss him. It'll be a year next week. Lisa's just so lucky Mike had life insurance. At least she was able to keep the house.
I'd hate for you and the kids to struggle if something happened to me. So I did a bit of research. There's one simple thing we can do right now to protect our family. That's getting real life insurance.
Applying for real life insurance is easy. Take Paul and Christine, for example. Paul gave Real Insurance a call, so I helped him organise cover right then and there. And like Paul, you can apply quickly and easily over the phone without a medical or a blood test. You simply choose a cover amount from $100,000 up to $1 million, which is paid quickly to your loved ones when they need it most. You'll also get back 10% of the premiums you've paid after the first 12 months with the Real Reward. Plus, for a limited time, when you take out cover today, you could get a bonus $100 gift card. Taking out real life insurance is one simple thing you can do right now to protect those that matter most. For a quick quote, call 139 479 or search Real Life Insurance now.
Our chefs spent months picking the best recipes, while our nutritionists picked the ingredients. But if it wasn't for the thousands of customers who picked at it, poked it, ate it and rated it, roasted it, toasted and posted it, chewed it, reviewed it, nibbled and quibbled, sipped, whipped and ripped, those who said no and those who said go, to them we say thanks. We couldn't have created our new glorious Woolworths food range without you.
That's why I pick Woolies.
What if there was a completely new way of solving Australia's energy crisis? Professor Mike Young, one of the country's top economic thinkers, has been turning his mind from water to energy. Join me, Sky News Business.
Welcome back. Let's check in on the Aussie market, see how we are tracking. We're under some pressure there for the first session of the week. Of course, fairly quiet because we have the Memorial Day holiday in the United States. You know, there's fairly light trading activity going through, but the broader market is off about 0.5%. We are still seeing selling in the major banks and the miners. The two sort of bright spots, as we were just discussing earlier, the REIT space, industrials actually and healthcare, both in positive territory there, but otherwise we are seeing weakness more broadly across the market. Now, we are still taking your calls. 1300 30 34 35 is the number, and you can send us an email, yourmoney@skynews.com.au. We're going to head straight to a caller. In fact, we have Don on the line from Queensland. Don, a warm welcome to the program. What's your question for David and Tony today?
Thank you, Dave and Tony. Thanks for taking my call. I'm holding Healthscope in my super fund, trading water a bit at the moment. It looks like it could probably go off to one of its hospitals for a bit of a resus itself. It's down, as you know, today, trading on a very high volume, about 10 million. It seems to have found a floor, a support level at about these prices, though its chart doesn't sort of cheer me to that extent. I guess people are cycling out of Healthscope, but I'm just wondering whether to be a bit contrarian or not. I'm also curious about why it's unfranked, and if you see a catalyst that perhaps might give it a bit of resus.
All right, excellent. Don, David, do you want to kick it off.
ASIC's favourite ones for last year and still is. Also, Morgan stockbroking are very positive on it. I think that it's always been looked at as the poor cousin to Ramsay. It did trade at a discount, and that was probably perhaps the attraction to it for people. It's technically, it looks dreadful, to be honest. Now it's sort of gone through that $2 mark. The issue with it is that if you like, the fear which grows on itself is its gearing, and which theoretically should receive a break when it finishes the big hospital up at Frenchs Forest in Sydney. Because at that point, then they get a whole lot of cash. They get $600 million from New South Wales government. Perhaps the fear is that that's being delayed. I don't know. There hasn't been anything come out of the company in the last week, but I have noticed as well as you have, it's been very weak. So I cannot tell you if there's someone in the market that knows something, but it's not a good sign.
Yeah, and it's weak again today. It's off almost 4%, so it's just under $2 for Healthscope. Tony, a view on the stock?
Yeah, look, it's had a pretty big downgrade from one of the very big brokers this morning, so that will probably explain some of the momentum just on the intraday basis. And to be fair, I haven't read the notes, so I don't know where that's sort of situated or what the key concerns are. You've got a new CEO there, ex-Telstra operative, but plenty of things to be done in Healthscope just in terms of turning the story around, especially from an investor perception perspective as well. As David rightly says, very much regarded as a secondary when we're looking at Australian domestic healthcare, private healthcare, compared to Ramsay Health Care. Obviously had that downgrade a couple of months ago as well, which didn't really help sentiment towards the stock, and you blend that with a bit of uncertainty, and again, not having had the benefit of reading this particular note and the key concerns, I'd just say that if you were taking the contrarian position, which the caller obviously wants to know about, would you be a buyer, I suppose, is a different way of putting it around here. I think for mine, I would actually be hanging back on this one. I would actually be waiting for a set of results coming up in August for this stock, just to reaffirm that things are back on track. The change program under the new CEO is in place, and essentially some of the progressive points you want to see around brownfield sites and redevelopment are back underway. So for mine, I'd probably be hanging in there. I wouldn't actually be using it as an opportunity to put out fresh capital at this point. And then, as David said too, just getting a bit of a read on the debt situation in the company as well.
Yeah, so perhaps waiting on a bit more clarity there, Don. I hope that answers your question. Appreciate your thoughts on that from both of you. Let's move on because we have another caller, Lisa, on the line, also from Queensland. Lisa, welcome. What's your question today?
Yes, good day, Leanne, and hello, panel. I was just wondering your views on Monadelphous. I bought when it was a fair bit lower, and was wondering if you think that it still has legs, or you think it should be taking a little bit off.
All right, excellent, Lisa. Thank you. $13.08 for Monadelphous at the moment. Tony, what would you be doing?
This is actually one of the most interesting consensus charts I've ever seen. You can't actually see it, but I've never seen a consensus chart where universally everyone's got a sell recommendation on the stock at the moment. Now, it's trading at 22 times at the moment. It's obviously in that infrastructure, engineering, construction space. I'm not aware of anything that would make you want to be a seller, but I would say on a simple valuation basis, the street actually targeting at about $8 or $9 of value in the stock. Now, to be fair, consensus can move pretty slowly. As we've seen with ALS, for instance, in the past couple of days, the sector itself is spending money again. There's, I guess, this derivative component, whether it be in engineering services or construction infrastructure services where Monadelphous are. There's plenty of reasons to actually be bullish on this particular sector, but just be wary of stocks that have run a little bit too hard and too fast. So to answer the viewer's question, I would actually be inclined to take a profit, not entirely on my position around here, because again, consensus can move very, very slowly, but probably look to move and diversify away from a single name in this particular sector to perhaps, just dribbling out that profit amongst a few others.
All right.
I think there's a bit of an M&A, not premium, but M&A sort of starting to be baked into the price because of the sector. There has been a lot internationally and a lot here more recently, so that's probably also led to some of the more recent support in the share price.
And not just for Monadelphous, but for the broader sector as well. Yeah. What is your view on Monadelphous? Would you look at taking some profits off here?
I would.
Yeah.
I would.
Okay.
But, we could be wrong taking over tomorrow.
Yeah.
It looks like it is. But on, as Tony said, a pure valuation space. I do like the space, but I think it's had a decent run.
Where do you like? Where in particular in the space would you look at?
I've gone long Downer. I think the whole fiasco with the Spotless takeover has been, from a market perspective, share price perspective, it was a disaster and went to sort of low fives. It's now recovered to 650, I think. But I still like it. I don't think you probably need to rush in and buy it right today because there'll be more twists and turns in the spotless takeover. And if any of those were perceived by the market as being slightly negative, then, you know, it'll be back closer to $6. So if that happens, yeah, there'll be a chance again. But I'm quite happy holding those. Yeah, I think it's the sector's turn.
What about for you, Tony? Mining services and any that you like?
Given, you know, David's hit on a really important point, which is M&A activity, which I think has distorted the share prices for a lot of these stocks in the past couple of months. Again, at the risk of sounding boring, when something's run like that and had a tearaway event on the premise of sentiment, be it around Spotless and Downer and, you know, in CIMIC, and you've seen the Spanish takeover, and a whole host of things have gone on in that sector, and infrastructure is essentially hot at the moment. I'd be inclined to kind of stand back. You know, I think about the second-order derivatives that are not necessarily in this space. Think about an Orica, for instance. Not suggesting you go and buy it, but I'd be looking for stocks like that as an opportunity to perhaps have a secondary play on something that's, again, a second derivative of something like mining than necessarily these areas. I'm not inclined to go long on this particular sector when it's run as hard as it has.
I have way more clients in Lendlease because I think it's a more conservative play. It's more diversified in its nature, and it's also got a lot more international operations. So for probably more across my client base and my portfolios, I have more in Lendlease than I would in, say, a Downer. Yeah, it's just a more conservative play.
Yeah, sure. All right. Well, Lisa, there you have it. There's some thoughts on Monadelphous and more broadly the sector as well for some other ideas for you. But thank you for the call. We will take a break. When we return, we'll be answering more of your questions. So give us a ring. 1300 30 34 35 is the number. yourmoney@skynews.com.au if you'd like to send us an email. Stick around.
Our chefs spent months picking the best recipes, while our nutritionists picked the ingredients. But if it wasn't for the thousands of customers who picked at it, poked it, ate it and rated it, roasted it, toasted and posted it, chewed it, reviewed it, nibbled and quibbled, sipped, whipped and ripped, those who said no and those who said go, to them we say thanks. We couldn't have created our new glorious Woolworths food range without you.
That's why I pick Woolies.
130 years ago, 7 ordinary men gathered in Broken Hill and dared to think big. The company they created that day was BHP, the big Australian. Today, the same hard work and imagination so valued by our founders has seen us grow into Australia's global resources company. Imagine what we could all achieve if we continue to think big. Think big.
Cleaning the tub is a back-breaking chore, and you can scrub your tiles, but it always needs more. There has to be an easier way. From the makers of the best-selling Hurricane Spin Mop comes the all-new Hurricane Spin Scrubber, the new cordless and rechargeable power scrub brush that cleans faster and easier. Even these dirty old tiles are no match for Spin Scrubber, blasting right through the grime, sparkly and clean every time. It makes quick work of calcium, soap and hard water stains, clear and clean in seconds. The secret is the rotating brush, spinning at 300 RPM. The incredible torque can bust through any caked-on crud with ease. So forget harsh chemicals. Now restore the shine and luster to any surface in a flash. And you'll never need batteries because it comes with the latest rechargeable technology. Forget bending and straining to clean the tub because you'll get this extension pole free. Now you can easily reach down into the tub to power away stains or into the shower to clean mouldy grout and tiles, even to clean those areas you couldn't normally reach. And we're not done yet. You'll also get this free Soft Flex cone brush that fits perfectly into corners. There's no easier way to get taps sparkling clean. Also use it to blast away the burnt mess on cooktops, even get into tiny crevices on the fridge door, or best of all, those hard-to-reach shower door rails. Call Global Shop Direct or go online and order your very own Hurricane Spin Scrubber for the special low price on your screen now. You'll get the complete Hurricane Spin Scrubber system, including the multi-purpose brush, extension pole, control, and the soft cone flex brush so you'll never miss another hard-to-reach crevice or corner again. You can't completely clean those large surface areas effectively without a flat brush. That's why we're including an extra large flat brush free. Use it around the rusty sink drain or to bust through the dirt on the shower floor. And there's no better way to power through the oven door grime so it wipes off in no time. The Hurricane Spin Scrubber is the cleaning tool every home needs. But if for any reason you're not satisfied with your purchase, just send it back within 30 days for a full refund of the product price. Nobody likes to get on their hands and knees to clean. Make those hard to reach and even back-breaking chores easy with the Hurricane Spin Scrubber. Order yours now.
Welcome back to the program as we take your calls. 1300 30 34 35 is the number. Now, this is what we're watching in the session. The local market is in negative territory there, down about 0.5%. We are watching falls in the major banks, the mining stocks and technology stocks today. In fact, Domino's Pizza, one of the bottom movers. We're off 3.2% for that stock. It's close to a 7-week low. This follows a downgrade from Morgans, in fact, to a hold. Now, shares in Sydney Airport are pushing higher, up 2.4%. This is amid talk that China is eyeing Sydney's new airport at Badgerys Creek as part of its One Belt, One Road infrastructure plan. Now, joining me in the studio are my guest hosts this afternoon, Tony Davison from Henderson Maxwell and David Manchie from Belvedere Share Managers. Also pleased to say that Lawrence Parker-Brown from Cosec Kadari Securities is joining us live from our CBD studio. Lawrence, great to see you there today. Just talk us through what you're making of the first session of the week. Of course, going to be very quiet in the United States tonight. Is that really what, the sense you're getting from your clients today?
Yes, as you say, we sort of looked at it in the morning, sort of 7 points up on the SPI futures, and sort of felt that there might be a bit of a softer mid-morning and afternoon. As you say, there's likely to be a lot of eyeballs looking at what's happening in the States with the Memorial Day, obviously the Dragon Boat Festival in China. There's a lot of sort of impetus to sort of wait and see what Tuesday holds. So a little bit of selling across the market, as you say. Yeah, there certainly is. Now, one of the stocks that we're watching is Certex. I know you're also watching it. It's proceeding with this $30 million buyback after winning a court battle that sought to block the move. Just tell us a little bit more about what's going on here. Well, as you say, it's been a really challenging sort of year for Certex. This is a stock that wasn't too long ago trading for around $40. The real challenge was Gilman Wong and disclosure requirements that led to his removal as the former CEO. And then since then, we've obviously seen that one thing that was sort of attracting a lot of attention was how the clinical trials would go. Now, it's not one we're going to get clients into yet. We do want to sort of see some sort of better news over a longer period of time. But the really savage selling off has attracted some interest, and obviously as a sort of sign of belief in the business, management are looking to, as you say, a $30 million buyback. So that's something that should be supportive of the share price in a sort of medium term, and overall something that's potentially a value. Now, I'm not saying we're getting clients into it, but nevertheless, this is a business that's got excellent distribution and it has been profitable in the past. So at the moment, trading at a real discount. We were just talking about Healthscope a little earlier as well, and we know that this is one that, you follow really closely. So for our viewer that was asking about it a little earlier, it is off about 3.4% at the moment, just around $2. Just give us your sort of recent update for Healthscope. Yes, and as you say, again, a sort of change in CEO. Ballantyne stepping in with his Telstra experience, potentially interesting in terms of bringing some technology towards healthcare. Healthscope's challenge is that with these brownfield sites coming on stream, they're sort of hamstrung, and this might not have been the sort of growth targets and the growth sort of strategy that the new CEO would have wanted. So at the moment, it has slightly changed our proposition. For clients that want to be patient, it's close to 52-week lows, but I think the business proposition moving forward is one where I'm cautious. I wouldn't be allocating more funds. If people are already in Healthscope and they're ready to be patient, then so be it, but we're not sort of seeing it as a buying opportunity at this juncture. Yeah, right, okay. Don, I hope you were still watching there because, that was Don's question a little earlier when he called in. Now, Oil Search, we're watching Oil Search also. It's bought this 30% stake in some prospecting licenses from ExxonMobil in PNG. What did you make of this news, Lawrence? Yeah, so obviously the gas is going to be a really big story this year, and it's obviously created a lot of controversy domestically. Now, the excitement would be that this is further augmenting the position that Oil Search have in Papua New Guinea. The challenge is that this is quite complicated in terms of actually distributing, and some of the capital expenditure will be quite hefty and quite complicated in order to sort of roll out. So it's an intriguing story, and obviously if you look on the charts for Oil Search, they have a really choppy trade. So people that were picking it up for sort of $6.50 did very well. I must say it wasn't one that was really something that we were too bullish on. It's probably trading at a point where you sort of feel that you might have ever so slightly missed the boat. So even though this is, on the face of it, encouraging news, the market on a soft day haven't been so supportive.
And would you be hanging in there if you are a holder of Oil Search? What is it at about $7.30 at the moment? Would you hang in there for further gains, or do you think it's time to maybe take some profits off the table?
Sure, I'd probably lighten my position if I was in. I must say some of our clients are in, but it's not something that we've got like a huge proportion of. So probably some lightening of the position based on their portfolio weighting.
How about for you, Tony? Oil Search, would you be looking at it at these levels at all?
Yeah, as you probably know, we like them pretty dull. So Woodside's our oil position at the moment, just simply because of its relatively low cost of production, dividend yield paying. It has a slight growth quotient. It's improved in the last year with just some acquisitions from BHP and some others. But for us, it's just a simple way to play the space. Now, for those who are more oriented towards, you know, something that runs a lot more quickly in the oil space, Oil Search or potentially Santos, you know, are the two ways that you'd want to be playing it at the moment. For mine, I'm a little bit sanguine about the oil market at the moment. So we had obviously a pretty big sell-off on the back of the OPEC news last week. We weren't entirely surprised that that was the market response, just given the way it had run up in advance of the actual announcement itself. But that having been said, expecting the oil price to kind of level between the 45-55 mark over the next sort of 12 to 18 months. It's interesting, you know, this weekend actually marks the start of what they call driving season in the United States, and kilometres driven and that sort of thing is actually weak at the moment in the United States as well. So that sort of will impact eventually, you know, one of the seasonalities in terms of impact or demand for oil. At the same time, you've got increased production in the United States. A lot of the things that we talk about, and I think that you've probably got an OPEC that will, as time goes on, fragment in terms of their willingness to hold on to these production cuts as fiscal positions in these countries bite. The bottom line is I think the oversupply story is here for a long time, and we'd rather play it through something that's clearly positively cash flow, less growth oriented, and that's the way that we sort of see Woodside at the moment.
Okay, David, what about you? How are you playing the oil sector, if at all, at the moment?
Look, I think it's a trading sort of sector. I think we're pretty range bound. If you looked at Oil Search's share price over the 12 months, that sort of reflects it. Was a classic example of it. I think that's, you know, you want to have some oil, hopefully buy at the right price, you know, the shares, I mean, in your portfolio, because there can always be another oil crisis with all the rubbish that's happening around the world. But it's not something that I'm wedded to as far as having a, you know, using an institutional term, an overweight position.
Sure. Okay. Just while we are talking, well, just moving away from oil for a moment, we've actually got a viewer email that's come in from Maggie. She's asking for the panel's opinion on Oz Minerals and whether this is a good play for gold as well as copper, given its low debt balance. So, Oz Minerals, I might just start off with you, Lawrence, a thought on this one.
Yes, I mean, I was going to raise that sort of whole point of the gold as an offshoot. Now, copper is quite an interesting proposition for emerging markets, and when you look at Oz Minerals in terms of the stock-specific news, this is a business that really struggled over the past, but now got its act in order. It's got a stronger balance sheet, a new management team that are sort of meeting its guidance targets. So this is now a more exciting proposition than it was at any time really in the last 4 or 5 years. And as you say, with that gold as a sort of byproduct, it is something that we get some clients into. It's not necessarily our favourite play, and if you want a pure gold play, we'd probably recommend something like Northern Star. But it's certainly one that's improved, particularly over the last 12 months. So one to sort of add to Maggie's watch list.
Tony, what's your view on Oz Minerals?
I love it. I think it's a fantastic company, low cost of production. So I concentrate more on the copper story than than any sort of gold credits in the equation. So for me, it's, as David points out, it's a purely copper play, basically producing for much less than $1 a pound, fetching more than $2 a pound in the market. Yes, Prominent Hill, which is a historic asset, is essentially in run-off. It's got a few years to run, but the growth opportunity is Carrapateena, and while they're yet to kind of get to a final investment decision and a full commitment to that project, it looks very much like it's going to happen, and in a very disciplined way when they do it. You know, essentially no debt on the balance sheet, you know, cash on the balance sheet, a really well-run company, and it's turned a corner. I think very highly of Oz Minerals. If you want copper, and I'll go back to what I said about Woodside before, in a very boring format, then this is the way to play it. The only caveat to the boring thesis, though, is Carrapateena, new project, all of the risks that run with a new project along the way. But for mine, I think they're taking a very orderly and disciplined process to making a final committed decision to actually going ahead with that, and I quite like that.
Okay, so as a copper play, one that you like, David?
Yeah, I mean, I had a near-death experience 5 years ago, and it's outperformed operationally ever since then, and the share price reflects that. What's really interesting of more recent times, and I'm sure the viewer will know this, is that it was pretty well on a bottom left to top right sort of trajectory last year and earlier this year. And then I just noticed, I think it was, I can't remember, it was about a month ago or maybe 6 weeks ago, Sandfire, who had actually been down, it started to get some support, and Oz, which is the other probably people think it's pure copper play. So the two of them are not that dissimilar, if you like, in a market that we don't have a lot of pure copper plays. And then Oz Minerals seemed to have a lot of sellers, so it actually came back quite dramatically at that time. It seemed to find a bottom a couple of weeks ago, I think, from memory, and it's actually bounced quite well, but it's still well and truly off its highs. It is, like I say, it's been one of those things that's over-delivered and under-promised, and so it reflects it. Plus, the copper price has recovered very well. We're at now $2.60. And there's talk also about in the market at the moment, institutional level, about potential supply cuts internationally. Particularly, the latest one is now in Indonesia, and we've still got Chile and an unresolved sort of strike scenario, which is the other big copper country.
Okay, excellent. There's some great thoughts for you to ponder there, Maggie. Appreciate the panel's view. Now, we do have a caller, and Lawrence, if you don't mind hanging on the line there as well. I think we have Mick on the line, I believe, from South Australia. Mick, a warm welcome to the program. What's your question for the panel today?
I just wanted your opinion on both the Costas Group and Invacare as to whether they have run their race or they've still got a bit of upside left.
Okay, excellent, Mick. Thank you. Invacare, I think, was the last question there. It's off about 0.7%, $14.85, and Costa Group was the other one there. Lawrence, just over to you on Invacare or Costa Group. Do you follow either of these stocks at all?
Modest, boring is good in lots of portfolios in terms of it being sort of a nice, stable defensive play. So we do think Invacare, particularly with some of the brands it has domestically, has some further traction. They obviously were trying to look to expand their footprint, I think, in California recently, and that didn't go wonderfully well. So we just like it, rather like a car sales for its pure business here domestically. And we think it's something that's, if you can pick up at a decent price, I wouldn't be buying it right now. I think there's further softness to come and there's sort of a selling period potentially in June, but it is sort of a staple in a lot of portfolios. So it's one that we sort of track and we quite like.
Mm-hmm. Tony, a thought on either of those?
Yeah, Invacare, obviously in the funeral home operation side of things, they had a few slip-ups in the past couple of years with an ill-fated foray into the United States. They're probably much better facing domestically, which they've now conceded that's pretty much what they're doing. Mm-hmm. With Invacare, as grim as it is, it's really about the death rate. That's what makes the company more money. If you have a bad flu season, you have a grim winter, whatever it might be, jokes and dark humour aside, that's really what spins the wheels at Invacare. So if you're seeing any nuance there of those sorts of things tripping through in terms of, a difficult winter, then Invacare is a pretty good way to play it. The other way to think about it is that funeral home operations in Australia are still very much a mum and dad or a family type business, very fragmented. So there's still plenty of upside there, but that having been said, as Invacare has grown, other operators, private operators in the space have gone out and bought others as well. So, the extent to which they can continue to grow is less the case. It's a relatively expensive stock, like it's really fully priced at the moment. For mine, I probably wouldn't be going near Invacare just at the moment. I really think it's probably about 15-20% overvalued. But then again, you have to take a view on healthcare and the ageing population and other things as to whether it'll go up.
Okay, your view, Costa Group or Invacare, David?
I don't follow Costa Group, so I really can't comment on it. Invacare, obviously, people my age, Invacare's been on the market for decades now, and it's continually performed, and hence that's reflected in its PE, high valuation. So it is probably worthwhile. I'm the same as Tony. I wouldn't be buying at these levels. I think there is a bit of a risk about where it's going to expand, and it's going to need to expand to justify the high valuation.
Okay, excellent. Mick, thank you for the question. Just before we leave you, Lawrence, I just wanted to ask you about Trade Me Group, teaming up with Afterpay. Just tell us a little bit more about this tie-up, this news today.
Yes, and as you say, I mean, I wouldn't sort of liken Trade Me to Amazon, but one of the things that is interesting in the space is that Amazon bring their whole ecosystem to do with payments. Now, obviously, Trade Me is a bit more like a sort of a Seek and an REA and maybe like an eBay hybrid, but it's quite interesting that this is going to be a way to sort of support people that want to pay sort of and acquire goods immediately, but then actually, you know, fund it slightly later. So potentially something that's supportive. On a soft day for the market, TME sort of had a bit of a bounce off this. So overall, a stock that we feel has potentially decent valuations in terms of PE, compared to the likes of Seek, which has really run hard. So an interesting one for a lot of people to have a look at.
All right, fantastic. On that note, Lawrence, we might let you go. You've been very generous with your time. Thank you so much for joining us this afternoon. Lawrence Parker-Brown joining us there from CoSec Kadari Securities. We'll take a break. We are still answering your questions. Give us a ring. 1300 30 34 35 is the number. Stick around.
Our chefs spent months picking the best recipes, while our nutritionists picked the ingredients. But if it wasn't for the thousands of customers who picked at it, poked it, ate it and rated it, roasted, toasted and posted it, chewed it, reviewed it, nibbled and quibbled, sipped, whipped and ripped, those who said no and those who said go, to them we say thanks. We couldn't have created our new glorious Woolworths food range without you.
That's why I pick Woolies. So, heard you sold the house?
Yeah, it's great, eh?
Did you use Purple Bricks?
Oh, no, they're just online, aren't they?
No, they're proper real estate agents, real people. Just don't charge commission.
Hey?
No commission.
Commisery. The misery you feel when you spent thousands on commission but got nothing more for your money.
I'll just get some napkins.
Save yourself from commisery at purplebricks.com.au.
Bedtime. Good night, Doris.
The big banks want to get their hands on your super. And they're putting pressure on our federal politicians to let them in. Banks aren't super. Authorised by D. Whiteley for Industry Super Australia, Melbourne.
Every day, the men and women of BHP gather across Australia and around the world to produce the resources that fuels our transport, powers our industries, warms our homes, cooks our food, and makes possible the technologies that will help build a cleaner, more sustainable future for all of us. Imagine what we can do next if we continue to think big. Think big.
Treasurer Scott Morrison told us the global economy is improving and Australia needs a plan to make the most of it. Just as the country needs a plan, so do individual businesses. A plan to start, to grow, and importantly, to end. By developing a succession plan, business owners not only develop certainty over how their ownership in the business will be passed on, they also get a sense of certainty on what their beneficiaries can expect to receive. But more importantly, they get a goal to aim for. Having goals really helps focus on a plan for achieving them. Good succession plans take into consideration unfortunate events which can occur and how they can be covered by appropriate insurance. With more certainty around the future, business owners can then concentrate on doing what they are good at, running their businesses.
A new federal budget could be a new opportunity for you. Find out more at suncorp.com.au/budget.
Warm welcome back to Trading Day. Now, we are going to just check in on markets around the region. If we just pull up how those stocks are tracking. In fact, all three of those indices are in positive territory. The Nikkei 225 up 0.2%, the Hang Seng and the Shanghai Composite all doing pretty well there. Let's get across more of these moves. Yvonne Mann from Bloomberg is joining us live from Hong Kong. Yvonne, just talk us through some of these moves. Of course, it's going to be fairly quiet tonight with the Memorial Day holiday in the United States. But how are we seeing markets around the region tracking?
Yeah, you got that right. Really don't have much direction in the markets here as we kick off the trading week. As you mentioned, the U.S., UK, China, and Taiwan also closed for the holidays. So dealing with some low volumes, low volatility across the board here as well. Despite the fact earlier this morning we got more geopolitical concerns with North Korea firing yet another ballistic missile earlier this morning. The market really shrugging off that once again. The yen erasing all its gains that we saw over the weekend and on Friday. And the Kospi yet again making another fresh record high. That is thanks to Samsung once again. Local reports in Korea saying the company sold more than 1 million Galaxy S8 phones since its release last month. That's twice as fast as we saw sales in the Galaxy S6 as well as the S7. So it seems like they really have moved away from that Note 7 debacle for now. While we are staying on tech here today, Nintendo really helping this rally on the Nikkei 225. We're up about 0.1% on the benchmark, but the stock itself at a 7-year high after Morgan Stanley raised its forecast on Friday. We're riding on this optimism here that the new Switch console has reignited earnings and brought the stock back to levels we saw during the Pokemon craze. And taking a look at other stocks as well, Tencent once again fueling the Hang Seng. We are up about 0.1%. So this tech rally in Asia still quite robust. Perhaps what is interesting is in the FX space, not so much dollar. That's been pretty muted, even after we did hear from the San Francisco Fed President John Williams saying that he thinks that these rate hikes are going to be gradual. But what has been a little bit more intriguing is the offshore yuan. Those moves there, we are seeing it up about 0.1% right now for the onshore renminbi. But what has been a pretty dull moves in the offshore yuan this year, we are actually seeing volatility now climbing back at the fastest pace since that August 2015 devaluation, and the currency has jumped close to 1% against the dollar in the last 4 days. There are signs here, according to traders, that the PBOC may be behind this advance. We see yuan borrowing costs in Hong Kong surging some 500 basis points last week before coming back down just slightly. So we're seeing a little bit of intervention here, but it's getting a little bit more expensive to be shoring the yuan. Leanne.
Yvonne, appreciate the update. Thanks very much for joining us. Now, we're going to get back to the market now. We are still taking a couple of your calls, and there's some emails for us to get through as well with my guest hosts, Tony Davison and David Manchi. Let's get into it because back to the retailers. We have a question on Super Retail. Momtaz has written in saying at the beginning of the session it went up. Now it lost all of the gains. Any announcement? What's your comment? What are your thoughts on Super Retail Group? Pretty horrible chart looking at that on the screen.
Yeah, it's been pretty tough. They guided, at the end of April, basically experiencing weak trading conditions in their auto and sports business, which is code for saying, like most other retailers out there, they're just finding headwinds tough. You blend into that, we've talked about it a few times, the Amazon threat. Although unknown, various analysts are talking about a potential 10 to 20% hit on a number of retailers like these. There's also currently a competitor in the market in some of their segments as well. And when I say a competitor, I'm talking about an online competitor that's already cutting prices. The bottom line is retail's tough at the moment. Yeah. Super Retail's very exposed to it. And at the same time, the guidance that the company made only 3-4 weeks ago certainly wasn't stellar in the scheme of things. It wasn't bad guidance, but any negative guidance at the moment, it tends to get flogged, and that's what's happened here. So for mine, I wouldn't necessarily be leaping out and buying these stocks at the moment. Again, we've seen this trend replicated a few times in the past year or so, is that stocks, the smallest slip, the smallest downgrade or nuance of a downgrade, they just get dumped, unmercilessly. And I think it's very difficult to then have these stocks actually pick up before the company guides with decent evidence. So for mine, I'd just be probably steering clear of that. If you're an owner of the stock, though, underlying business itself, I think that the share price moves are frankly unjustified. But again, you've got to let some time pass on this.
Yeah, especially those retailers, those shareholders want some bit of reassurance, but certainly not the case with Super Retail.
It's caught up in the whole discretionary spending. Every you could go over another half a dozen, and they're in the same. The charts wouldn't look dissimilar. And as Tony says, it's actually had its own update, and it was a little bit disappointing. Yep. Look, I personally think that if you've got them, walk into a BCF shop or whatever and see how many people are there, and if you think that's a good shop and whatever else that's got legs, then great, hold on to them. But it's, as the company's saying, it's a tough gig right at the moment.
Okay, well, we are seeing it, it's up ever so slightly, but hovering around $7.38 there today for super retail. Let's move on to the miners again. We have a question on Fortescue, which is off another 2% there today, $4.74. This is coming from Rosie. Hi, panel. I'd like your opinion. When will investors start buying Fortescue? One of the most wonderful, biggest, successful companies, punished for their success. Surely this must be a steal. What are your thoughts on the stock?
That's a pretty rosy sort of assessment. I mean, don't forget this has come from $1.50. It was almost going broke a couple of years ago, so it has actually had a good run. So I don't know if it's being punished for its success. It did run up further, and it's come back with the iron ore price and the geopolitical concerns we have around the world. So you know, it's given some back, but the outlook for iron ore hasn't deteriorated. There's still going to be a huge need for it in the world, both in China and in the US. So you're just going to get these gyrations. Fortescue is obviously a pure iron ore play, and the grade of iron ore is slightly less, so therefore you see more volatility in both its in the share price. So you just have to accept that that's going to be a volatile share price. But there's nothing wrong with the company. It's a good company.
Yeah, it moves with the iron ore price, but the health of the balance sheet is looking pretty good.
Definitely. You know, it's just really a derivative of the iron ore price.
Yeah.
Iron ore is now at the lowest price it's been in 2017. It's that simple, and the share price has moved with it. Think about a company that can put a tonne of iron ore on a boat for less than $15 and at the moment it's fetching more than 55. They're a contract and their iron ore is lower grade, but even if their margin's still, say, 60-70%, as would likely be the case, this is a company that produces vast amounts of free cash flow. They've been very diligent in paying down their debt. They're on a forecast yield at the moment of nearly 7% before we start talking about tax credits. Debt's been pushed out to well beyond 2020. There's plenty of reasons to own this stock. You've just got to have the iron ore price going in the right direction. So for mine, if anything, if I was to see some favourable signs towards iron ore prices going back up, this is actually a fantastic stock and a good way to play it.
Fantastic. Appreciate your thoughts, Rosie. Thank you for the question. Big thank you to all our callers and emailers, but of course our guest hosts as well, Tony Davison and David Manchi. Thank you to both of you.
Thank you.
We'll take a break on that note. When we return, more analysis on today's trade. Independent analyst Gary Burton will join us next.
Our chefs spent months picking the best